expect this will continue for years. So that competitive devaluation scenario is continuing. By the way, countries think they're going to improve exports. That's not how you improve exports. You improve exports with, technology, innovation, education, good business climate, low taxes, value added. There are a lot of ways to promote exports, but cheapening your currency is not one of them. All cheapening the currency does is get inflation. But that's the point. The reason central banks are cheapening the currency, they tell the politicians, the central bankers say, is to promote exports, but that's not true. The real reason is to import inflation in the form of higher import prices. The U.S. is a net importer. We import more than we export. Japan imports massive amounts of energy. So for them, a cheap currency means higher import prices. That means inflation. That's what the central banks really want.
Now, you previously said that you expected the Fed to taper in September or never, which I kind of like that rhyme right there, but meaning September was Bernanke's last chance to start winding down this third round of QE. Do you still believe this, or do you see the possibility of Yellen implementing a taper anytime soon?
No, I mean, by the way, what I said when I said September or never, I said all summer that the Fed would not taper, but if they were going to taper, September was their last chance. But no, I did not expect tapering at all, and I still don't, as a matter of fact, because, in May when Bernanke started talking about this, he said, we're going to taper, reduce asset purchases before the end of the year if the economy performs in accordance with our forecast. The markets focused on the first part, which was the tapering part, but they ignored the second part, which was the forecast. The Fed has the worst forecasting record of any major institution I can think of. So when they said we expect the economy to get better, my assumption was it would actually get worse, which it did, because, as I say, the forecasting is always wrong. So my expectation was that they would not taper. Now that we're in December, I don't see the conditions under which they could possibly taper, absent structural changes. We're in a depression. If the Fed were to taper, I don't expect it, but if they did, they would be tapering into weakness, and they would guarantee a recession in 2014. I think the data will bear that out. They're not going to taper. They painted themselves into a corner, Aaron, where there are no good ways out. If they taper, they're going to taper into weakness and cause a recession. That's why I don't expect it. But if they keep printing, eventually they'll destroy confidence in the dollar and create an international monetary crisis. So there are bad outcomes either way, but this is what happens when you manipulate markets. You paint yourself into a corner where there are no good ways out.
Now, this is actually perfect the way you set this up, because it leads to my next question. There were a couple of papers presented last week by two Federal Open Market Committee economists, and they suggested that the unemployment threshold, which currently is at 6.5%, be moved down to 5.5%, excuse me. And this could suggest keeping rates low through 2017. Now, like you kind of mentioned before, is this just the Fed testing waters here, or how long can they delay the inevitable taper? Like you said, we're in a depression. How long can they wait before they taper?
Right. Well, a couple things on that paper. I mean, the Fed always speaks in code. When they say, we're lowering unemployment, the unemployment target from 6.5 to 5.5. By the way, if you go back to December 2012, December 2012, when the Fed first announced that target, it was never a trigger. It was always a threshold. In other words, they didn't say, we will raise interest rates when unemployment gets to 6.5%. They said we won't raise interest rates until it gets to 6.5%, but it could get a lot lower than that before we raise. And this paper just confirms that, now saying 5.5. But the point is, unemployment is going down for the wrong reasons. Unemployment is not going down because we're creating a lot of jobs. It's going down because labor force participation is collapsing. That's extremely negative for the economy. GDP is really just the sum of labor force participation plus productivity. So how many people are working, how productive are they? That's all there is. There's nothing else to the economy. And with the number of people shrinking at an unprecedented rate, going back to levels last seen, I think, in 1978, and that's when women were, entering the workforce in very large numbers. So we've gone backwards in time to a time when women did not participate in the workforce to the extent they do today. So our labor pool is, in effect, dropping. That's extremely negative for the economy. What that paper really says is that they've given up on real growth, and they're targeting nominal growth and inflation. This is just nominal GDP targeting by another name. And if real growth isn't good enough and you have to get nominal growth to a certain level, you make up the difference with inflation. And that's what the paper really says. Let's bring on the inflation. And to do that, they're just going to print money. And so that's what Yellen is doing. Yellen, by the way, is in that paper is completely in accord with her views as expressed in prior speeches and papers and other interviews she's given. So I just think they'll keep printing at the level. Actually, I expect the next change in policy will not be tapering. It'll be an increase in asset purchases.
Well, there are a couple of reasons for that. One question a lot of people have is, gee, how could you print $4 trillion almost and not get inflation? And the answer is that it's like making a ham and cheese sandwich. You can't do it with just the ham. You need the cheese. The money printing is the ham, but the cheese is what's called velocity, or the turnover of money. So the Fed can print all the money they want, but if people don't want to borrow it, don't want to spend it, and they'd rather stay home and watch TV than go out and take their friends to dinner, then you're not going to get the inflation. And that's the kind of mode we've been in for the last 5 years, and that's because we're in a depression. This is not a normal business cycle type recovery. We're in a global depression. We've been in it since 2007. And that is very largely behavioral and psychological. As I say, the Fed has to basically change the psychology and get people to get out there lending and spending the money again. So that's one impediment. But the other problem is that the difference between a depression and a normal recession and recovery cycle is that depressions are structural. A normal business credit cycle is cyclical, meaning that the economy gets a little hot, the Fed tightens policy, the economy cools down, unemployment goes up, and they go, okay, that's enough. So now they ease policy, and then jobs are created, and the economy goes up again. So it's like a sine wave. It goes up and down, up and down. It's the same business cycle we've seen over and over 20 times or so since World War II. That's not what we're in today. One of the reasons that expectations of a recovery have been disappointed, 2009, everyone talked about green shoots. Those turned brown pretty quickly. The point is, we're not in that normal recovery. Depression is structural. It's a structural problem. You cannot solve a structural problem with a cyclical liquidity solution, and that's the biggest problem. The Fed's trying to use money to solve a problem that cannot be solved by money. It can only be solved with structural changes and a change in confidence. And so, but the problem is they think it can. The fact that it's not working doesn't deter them because they think they can print enough money to get the economy going. And my concern is that they're printing the money to get the economy going. It won't work. It's like treating cancer with aspirin. It's not going to be very effective. But because they think it is, they're going to keep printing and ultimately collapse confidence in the dollar itself.
And very interesting. I want to get to the collapse in the confidence of the dollar, which clearly is the sort of backbone of both of your books. And we'll talk about that in a second. But I because you just mentioned the idea of a structural change in the U.S. economy, I wanted to ask you about three things I see as being different about our economy today. And the one thing is, I think one of the reasons why it's been hard for people to add new labor, to add new employees, is because 65% of American jobs today involve information processing in one way or another. And those jobs are constantly under threat of being replaced by computers and software and networking solutions. And I'm beginning to see this even more and more in finance. And Jim, I know you've seen it too. The number of new smart ETFs, the number of algorithmic trading systems, people all across finance are starting to get replaced with computers. That's just something that I see because I work in that industry. Another example of a structural problem is during the last credit cycle, there wasn't a debt liquidation. So the amount of debt that the U.S. economy is still carrying has never decreased. Now, we've replaced which types, but there is still an enormous amount of corporate junk bond out there, for example, and that never got liquidated. And so now, if you look at junk bonds in particular, you'll see that the mix of credit inside the high-yield market is as low quality as it's ever been. So that means that there are a lot of weak companies that still have a tremendous amount of debt on their hands. And then one last thing, and I would love to hear what you think about this because it's kind of counter-cyclical to what you're saying about the risks to the dollar as the de facto world reserve currency, is the enormous change that has taken place in the U.S. current account deficit thanks almost entirely to the shale oil production. I see all these three things as being inherently deflationary. That is, right, the debt burden, the massive gains in information productivity, and, of course, enormous increases into our economy's ability to produce oil and gas. What do you think about those three structural changes and how they relate to your overall economic thesis?
Well, Well, they fit in very nicely. I agree with them at a certain level, Porter, but let me maybe take it a little bit deeper. On your first point about, robotics and technology and automation replacing jobs, that's certainly true, and that is certainly a structural issue. It's a good example of the difference between a structural issue and something that could actually be solved by money. Printing money is not going to solve that problem. But you go back to 1800. In 1800, 95% of the American people worked on farms, and they produced enough agricultural output to feed themselves plus the other 5% who were living in the cities. But today, 3% of the Americans work on farms, and they produce enough food to feed themselves, the other 97%, and export abroad. So all those agricultural jobs are destroyed. Now, we're not sitting around saying, gee, we need to go back and create all those farm jobs. Why aren't 95% of the people on farms? Those jobs are wiped out, but the economy moved on. We created industrial jobs, we created service jobs, et cetera. And so that's an example of how we shouldn't lament the lost jobs. What we should be lamenting is why aren't we creating the new jobs?
Bingo.
Skills? And the answer there...
Hold on, before you go into the answer,
yeah,
let me just tell people the way this would normally happen, and I agree with you, is there was an enormous depression in 1893, and because of the new mechanization that was coming to farms, and that, and of course all the railroad debt, and so those things had to get wiped out. That overcapacity had to get liquidated in order for new jobs to be created. That capital had to be freed up, and it was through the liquidation process.
That's right. So we need that again, and that kind of gets to the second point, which is, you say the debt hasn't been written off. That's exactly right. Now you go back to 2008. What did Bernanke say over and over? We are not going to make the mistakes of Japan. Well, guess what? We made every single mistake of Japan. When Japan confronted their crisis, and they're still in it, by the way, people talk about the lost decade. How about the lost 3 decades at this point? But this started in 1990. What did they do? They did not write off the debt. They did not close the bad banks. They did not fire people and put some people in jail. They did not make structural changes. Instead, they propped up the banks, kept all the debt on the balance sheet, kept the management in place, and made very few structural changes. Flash forward to 2008. What did we do? Propped up the banks, bailed them out, kept the crooks in their positions so they could continue to collect bonuses, and we didn't write off the debt. We should have shut down Goldman Sachs, Morgan Stanley, Citibank, Bank of America, should have been taken over by the government. The equity should have been wiped out, so, hey, stockholders, you get zero. Too bad. Bondholders, you're going to get a haircut. We don't know how much yet, but we'll get back to you on that. Depositors and counterparties, you're protected because we don't want to, trash the system. We just want to clean out the rot. Strip the bad assets out, put them in a government trust for the benefit of taxpayers, sell them over 20 years or however long it takes, give that money back to the taxpayers, and then take the clean bank, IPO it, back to the marketplace so it's privately owned because I don't want the government to own the banks forever. And now you've got a clean bank that can actually make loans.
Yeah, we did that. It was called AIG.
Right, but none of that happened. None of that happened. What happened instead was we propped everything up, kept it in place, kept the bad debts on the book, kept the system the way it was, and kept the people. So is it any surprise that we're stuck in this rut 5 years later? So that's the structural problem.
I really appreciate him coming on with us. This is such a big deal, what you're about to hear in the next hour. The death of money, the coming collapse of the international monetary system. And what's in the news today? There is an acceleration out of the dollar by allies like South Korea, not just China, not just Russia, not just Japan, not just the Middle East. This is a huge deal and being done by design. Because before global governance can come in, the dollar has to finally die. They're going to ride the horse till it dies. But we have a real financial expert with us. The first half of the interview, we're going to skip this network break. This is so important. With James Rickards, will be on the monetary issues and his new book and his last best-selling book as well, Currency Wars. Then we will get into the insider trading he witnesses, an incredible whistleblower. James Rickards is the author of the national bestseller Currency Wars, The Making of the Next Global Crisis that predicted everything that happened in 2008. The Death of Money of the Coming Collapse of the International Monetary System is his latest book. He is a portfolio manager and partner in the Merchant Bank based in New York. He's also a counselor and investment advisor and has held senior positions at Citibank, Long-Term Capital Management, and Caxton Associates. In 98, he was the principal negotiator for the rescue of LTCM, sponsored by the Federal Reserve. His clients include institutional investors and government directorates. Mr. Rickards has delivered papers on risk at the Singularity University, Los Alamos National Laboratory, and has written numerous articles on risk management. He is also an advisor on capital markets to the U.S. intelligence community and the Office of the Secretary of Defense. JamesRickardsProject.com is the website. We'll put that up on screen for TV viewers. Thank you for coming on, sir. I really appreciate it. And you've got the floor to break down in layman's terms, but then more technical, what we face, where we are. And then I want to get into the big picture and basically how people can protect themselves. Thanks for coming on.
Thank you, Alex. Great to be with you. And yeah, the new book, The Death of Money, it sounds like a provocative title, but it's actually not meant to be that provocative. The international monetary system has collapsed 3 times in the past 100 years. It collapsed in 1914, again in 1939, and again in 1971. So these collapses happen every 30 or 40 years, and it's been a little over 40 years since the last one. Now, that doesn't mean it collapses tomorrow like clockwork. It just means that no one should be surprised if it does. And there are plenty of warning signs, official actions, pointing very much in this direction. And then, so what I do in the book is I take the reader through the instability of the system. I say, it's not a question of committing errors in the future. The errors have already been committed. The blunders have already been made. It's like snow that's piled up and we're waiting for the avalanche. We're just waiting for that one snowflake to bring it all tumbling down. So that's actually fairly foreseeable. What I try to do is say, okay, when that happens, because it has happened 3 times before, what comes next? What will the future international monetary system look like? And then go all the way back to square one. What can investors do today to sort of prepare for that? Well, look, I just I don't have to get into any hidden conspiracies. I just take their actual words. I met with members of the Federal Open Market Committee. I've met with central bankers, and privately, not publicly, but privately, they will tell you they don't know what they're doing. They are making it up as they go along.
Exactly.
They say, we try this. If it doesn't work, we pull it back. If it works, we try a little more. I mean, the Federal Reserve has had 15 separate policies since 2009. The forward guidance, first it was 2012, then it was 2013, now it's 2015, QE1, QE2, QE3, which had Part A, Part B, Operation Twist, currency wars, you name it. I mean, on and on and on. When you have 15 policies in 5 years, you don't know what you're doing.
Exactly. So bottom line,
it's basically
bottom line, Judgment Day is coming. And the question is, what will Judgment Day look like?
Well, Judgment Day will look like a collapse of confidence in the U.S. dollar. And, people say the dollar isn't backed by anything. Actually, it is backed by one thing. This is what Paul Volcker says, and I think he's right. It's backed by confidence. If people believe the dollar is a store of value, they will continue to use dollars. But the minute they stop believing that, the dollar can collapse like a house of cards. Now, the problem with the Federal Reserve in particular, and I would say the U.S. Treasury, they take confidence for granted.
The Death of Money is the book, available in bookstores here. I mean, the dollar is being cut off every day. And it is just very, very frightening because I talk to the average person out there and they say, I don't care if they shut down coal power plants. I don't care if they shut down somebody's business. I don't own it. I don't care if the dollar dies. Let it die. Alex, this system needs to come down. America's corrupt. I'm sick of it. Let it all come down. Well, yeah, it is corrupt, but it's not America. It's a multinational system, and it's going to hurt us, folks. It's going to hurt the average person. I don't care if the stock market goes down. I don't own any stock. It affects everybody you work for, where you go, the bonuses you get. It's ridiculous how self-centered the average American is. And I'm not saying everybody, but we were very morally upright people on average when we had the Great Depression, and it was rough. And I think what we're about to see could be even worse. What do you briefly say to that, James Rickards, best-selling author and top analyst, about what a depression would look like with this type of population?
Well, if you want to know what a depression looks like, look around, Alex. We're in a depression. This depression started in 2007, and it will continue indefinitely until we get some structural changes, which I don't see on the horizon. Now, a lot of people don't know what the meaning of a depression is. They assume it means continuous declining GDP, but that is not the definition. You can have growth in a depression. What it means is the growth is depressed relative to trend. So a trend, long-term trend of growth in the United States is, say, 3.5%. And by the way, in the short run, you can grow 4, 5, or even 6%, as we did during some of the years when Ronald Reagan was president, because you're bringing unemployed people back into the labor force at a faster rate. So trend is 3.5%. Short-term growth is 4 or 5%. But if you're actually growing at 1, 2%, which we are, that's a depression. It's the gap between the potential and the actual, and that represents lost wealth. And never make it up. So, I mean, you have to be 90 years old today to have a living memory of the Great Depression. So essentially, basically no one knows what it feels like. Well, except we do. It feels like this. And I've had people say, well, Jim, if we're in a depression, where are the soup lines? The soup lines are at Whole Foods, because you get your food stamps on a little debit card, and you can walk into Whole Foods and get some gourmet soup to go. So it's not that we don't have soup lines, but they're just in the supermarkets. They're not on the streets. But you look at labor force participation, you look at real wages, you look at unemployed, underemployed, people working part-time, wish they had full-time jobs, actual growth. We're in a depression now. Now, could it get worse? Yes, it could get a lot worse, because you can put a financial panic or financial collapse on top of a depressed economy, and that's what I see coming.
Sure. I mean, if the welfare checks don't show up, or if they don't have the buying power, it's the same of them not showing up. Cities will burn. I mean, that's just a fact. And the Pentagon knows that. Do they think a bunch of armored vehicles are going to keep everybody safe?
Well, they're hoping it doesn't come to that, but they're certainly prepared for it. I mean, we see, not news really, the militarization of local police. As I say, these are not, your local police force are not people who get kittens out of trees. They've got flashbang grenades, high-tech battering rams, night vision goggles, tear gas, automatic weapons, body armor, armor personnel carriers, and they'll break down your door for, a simple, credit card fraud or something. So, and there was a case the other day where sadly they threw a grenade and blew the face off a 2-year-old child sleeping in a crib. So that's your local police force.
But if you're illegal and have an aggravated felony, you can come right on in. I mean, this is becoming bizarro world. What does your gut tell you? Because, rich elites can always run to the next safe country. But to me, the United States does not look like a very good place to be during a full-on collapse. 20% chance of full-on collapse, 50%. I mean, the depression just keeps getting worse and worse. I agree by all metrics. We've been in a depression since 2008 or earlier. Most real economists agree with that. But, I mean, how bad will it get?
Well, the next financial crisis will be the worst in history, Alex, and that's not just an opinion or a wild guess. It's actually based on the science of complexity, which I talk about in both my books, The Death of Money and Currency Wars. Complexity theory basically looks at the scale of a system. That's a fancy word for size, but here's the point. When you triple the scale of a system, you don't triple the risk. You increase the risk by an exponential factor, 10 or 100 times. So in 2008, what did we hear about ad nauseum? Too big to fail, too big to fail, too big to fail. Well, guess what? The 5 biggest banks in the United States in 2008 today are bigger. They have a larger percentage of all the banking assets. Their derivatives books are bigger. So everything that was too big in 2008 is bigger today, which means the next collapse will be exponentially bigger. And it was all the Fed could do to put out the fire last time. The next one's going to be bigger than the Fed. It's going to be over to the IMF. And there's no, by the way, I talked earlier about these special drawing rights. That's the world money, the IMF issues. Well, there's no way they're issuing that without Russian, Chinese, and other people's approval, because they're all members of the IMF. The G20 is sort of the de facto board of directors of the IMF. And they're not going to say, hey, let's just issue a bunch of SDRs so we can prop up the dollar. They're going to say, let's issue SDR so we can bury the dollar once and for all. Now, the impact of this is just inflationary at best, and possibly hyperinflationary. It doesn't mean the dollar is going to go away. You'll still have dollars, but they'll be like Mexican pesos. In other words, the dollar will be a local currency that you use to go down to, restaurant or hairdresser or whatever, but it won't be used for the big things. When I say the big things, the price of oil, settlement of balance of payments between countries, probably the financial statements of the 100 or so largest global corporations. So, a few years from now, when you get your financial statement from IBM or General Electric, it'll all be stated in SDRs because they're really global corporations. So this SDR is the coming thing. Now, it might not work. It will definitely be tried. As I say, the blueprint's already there. It's on the IMF website. Secretary Geithner talked about it. He said he was open to it. Madame Lagarde, Christine Lagarde, head of the IMF, talks about it all the time. So the plan is already there. It will definitely be tried. Whether it works or not is a different question. If people lose confidence in the dollar, why would they have any more confidence in another form of paper money called the SDR? Well, if it works, it will only be because no one understands it, which is why education is so important. That's why I've read my books and do interviews like this one, just try to explain it to people in very straightforward terms. If it fails, however, which it might, then you're probably going to have to bring gold back into the picture, not because you want to, but because you have to, just to restore some confidence. But there's another side to this, which is as what I call the money riots break out, as confidence is lost, as society begins to disintegrate, you'll see a neo-fascist response, executive orders, militarized local police, National Guard. We already have the wiretapping. We already have the surveillance. The cameras are there. By the way, every toll booth in America, we think they're there to collect tolls. They're actually surveillance and interdiction points. And the new thing, of course, is the driverless car. Well, imagine going around a driverless car and the government wants to turn it off and come and get you.
Meanwhile, the LAPD announced what they'd already been doing covertly. Even felony illegals are going to